For decades, Americans were told one simple story. If interest rates fall, homes become affordable. Now, the President of the United States is trying to force that story back into reality. Donald Trump says he has ordered his representatives to buy $200 billion in mortgage bonds, not through the Federal Reserve, but through Fannie Mae and Freddie Mac. The goal is blunt: push mortgage rates down, lower monthly payments, make homeownership possible again. It sounds bold. It sounds decisive. It sounds like government finally stepping in. But here is the uncomfortable truth. Housing in America is no longer just about interest rates. Even after rate cuts, mortgages stayed high. Even after stimulus, inventory stayed tight. Millions of homes are missing from the market. So the real question is not whether this move is dramatic. It is whether it is enough. If you want to understand why this moment matters, stay with me. Because before we talk about solutions, we need to define the problem itself. At its core, this is not just a housing story. It is a story about power, institutions, and limits. The president is proposing to use financial muscle to solve a social crisis. Buy mortgage bonds, lower yields, reduce borrowing costs for millions of families. In theory, the logic is straightforward. When a major buyer steps into the mortgage market, demand rises. Bond prices go up. Interest rates go down. That playbook is familiar. The Federal Reserve used it during the pandemic. And for a brief moment in history, mortgages became astonishingly cheap. But today's housing market is operating under very different conditions. Rates are only one part of the equation. Supply is the other. Millions of homeowners are locked into ultra-low loans from years ago. They are not selling. Builders are not keeping up. Inventory remains near historic lows. So before asking whether buying bonds can lower payments, we must ask a more fundamental question. What happens when financial tools collide with a structural shortage? To understand why this matters, we have to step back. Not months, years. After the financial crisis, America rebuilt its housing system slowly, cautiously, and then the pandemic hit. The Federal Reserve flooded markets with support. Mortgage bonds were bought at massive scale. Rates collapsed. Home ownership surged. But something else happened at the same time. Supply froze. Construction lagged. Zoning stayed tight. Labor and material costs rose. And when rates later climbed, the market locked in place. People with cheap mortgages stayed put. Listings dried up. Sales stalled. Today, the country is short by roughly 4 million homes. That gap did not appear overnight. It is the product of years of underbuilding. So when rates fell again, affordability did not return. Because price is not just about money. It is about availability. This is the backdrop Trump's order enters. A market shaped by scarcity, not just cost. And that context explains why the next phase is so volatile. Then came the announcement, sudden, public, unfiltered. The president posted that $200 billion in mortgage bonds would be bought, not suggested. Ordered. Fannie Mae and Freddie Mac were named as the engine, two institutions once blamed for a financial collapse, now described as sitting on an absolute fortune. The message was clear. If the market will not cooperate, the state will intervene. Almost immediately, questions followed. Who exactly would execute this order? Under what authority? And how fast? Traditionally, this power belongs to the Federal Reserve, not the White House, not housing agencies, yet within hours, a signal arrived. The head of the Federal Housing Finance Agency responded publicly, "We are on it." That single line changed the tone. This was no longer hypothetical. Markets do not wait for legal clarity. They react to intent. And the moment this crisis moved from rhetoric to action, a deeper tension was exposed. Because once government enters markets this directly, it reshapes expectations in ways that are hard to control. Here is where the mechanism matters, because buying mortgage bonds is not magic. When a large buyer enters the market, demand rises. Bond prices increase, yields fall. Lower yields usually translate into lower mortgage rates. Usually, but mortgage rates are not set by policy alone. They reflect risk, liquidity, and long-term expectations. During the pandemic, the Federal Reserve bought at overwhelming scale, and even then, rates did not fall evenly. They fell because fear collapsed, demand for alternatives. Today, the conditions are reversed. Inflation memories remain, debt levels are high, and investors demand compensation. So even if $200 billion is deployed, the effect may be partial, delayed, or uneven. This is the hidden mechanism most people miss. Financial intervention can move prices, but it cannot create houses. If supply does not rise, lower rates may simply push prices higher again. And that creates a paradox. Helping buyers today may make homes less affordable tomorrow. This is not failure. It is a system behaving as designed. Then the second crisis begins to form. Quieter, but more dangerous, because once markets sense intervention, behavior changes. Investors reposition, builders hesitate, buyers rush in, afraid of missing out. If rates dip even slightly, demand surges. But supply does not respond. It cannot move that fast. So prices rise again, not slowly, abruptly. The very tool meant to restore affordability starts inflating the market once more. At the same time, uncertainty spreads. Can the president do this without Congress? Will courts intervene? Will the policy last? Markets hate ambiguity, and housing depends on confidence. If buyers fear reversal, they delay. If lenders fear risk, they tighten. If builders fear volatility, they pause projects. This is the second shock, not a crash, a freeze. And freezes are harder to fix than collapses, because once trust erodes, even cheap money cannot force movement. This is the moment where good intentions collide with reality. And this is where the story stops being abstract, because housing policy is never just about markets. It is about people. If you are a renter, you feel trapped. Prices are high, supply is thin, waiting feels endless. If you are a buyer, you feel teased. Rates may fall, but listings are scarce. Bidding wars return the moment hope appears. And if you already own a home, you are frozen in place. Selling means giving up a cheap mortgage. Moving means paying far more for less space. So every group waits, and waiting becomes a form of pressure. This is why rate cuts alone have failed. They touch financing, not reality. When policy focuses only on money, it forgets something fundamental. Homes are not stocks. They cannot be created by keystrokes. If you feel frustrated, you are not alone. This is not about personal failure. It is about a system stretched beyond its design. And when millions feel the same tension at once, the consequences do not stay local. That tension does not stop at America's borders, because housing is now a global signal. When the United States intervenes this aggressively, markets notice. Capital shifts, yields move, risk is repriced. Mortgage bonds are not isolated instruments. They sit inside pension funds, insurance portfolios, global balance sheets. If the US pushes yields down artificially, money looks elsewhere for return. Emerging markets feel it. Currencies react. At the same time, the dollar remains dominant. So American housing policy quietly exports volatility abroad. There is also a political signal. If Washington is willing to bend institutions for affordability, other governments may follow. And once housing becomes a political lever everywhere, markets grow fragile. This is how local crises scale. Not through headlines, through incentives. Housing shortages feed inequality. Inequality feeds polarization. Polarization feeds policy shocks. And those shocks ripple outward. What began as an attempt to lower monthly payments now touches geopolitics, capital flows, and trust in institutions. Which brings us to the hardest question of all. What happens next? The future now splits into three paths. And none of them are simple. The first path is the optimistic one. Bond purchases, calm markets, rates edge lower, confidence returns. Builders slowly respond. Supply inches up. Affordability improves not dramatically, but meaningfully. This is stability without transformation. The second path is more likely. Rates fall briefly. Demand surges faster than supply. Prices rise again. Affordability barely improves. Frustration deepens. Policy becomes reactive instead of strategic. This is motion without progress. Then there is the third path, the dangerous one. Legal challenges stall execution. Markets lose faith. Intervention appears political, not credible. Rates stay high. Supply remains tight. And trust erodes further. In this scenario, housing stops responding to signals at all. It becomes locked by fear and uncertainty. These futures are not driven by ideology. They are driven by structure. Housing responds to time, incentives, and confidence, not declarations. Which is why the final lesson matters more than any forecast. Here is the insight we cannot ignore. You cannot solve a supply crisis with financial shortcuts. Buying mortgage bonds may ease pressure at the margins. It may help some families for some time, but affordability is built, not engineered. Homes require land, labor, materials, permits, time. When leaders promise instant relief, they are responding to pain. But pain does not change physics. The real solution is slower, less dramatic, politically harder. It means building more, reforming zoning, reducing friction. Until that happens, every intervention will hit the same wall. This is not a failure of leadership. It is a reminder of limits. If you want to understand where housing goes next, do not watch interest rates alone. Watch supply, watch trust. Watch whether institutions are strengthened or bent. Because in the end, markets remember structure longer than promises. And if you want to follow how this story continues, stay with me.